Alright, we left off the last time just getting into the LIFO method of inventory costing. So just to recap slide 24 here real quick. When LIFO is used, the assumption is the opposite of FIFO. That is, the last ones purchased are the first to be sold. And as the text in this slide stated, this is seldom the case for the actual flow of the goods. A couple of examples are given in the text and on the slide here that are exceptions to the rule of the physical flow, where the last ones in actually are often the first to go. It's goods that are stored in piles such as coal or hay. Alright, moving to slide 25, showing the detailed calculations here involved in LIFO. And note the change in the cost of the ending inventory and cost of goods sold using LIFO. Ending inventory is less than FIFO. Cost of goods sold is more. Therefore, LIFO usually leads to lower net income if unit costs are increasing over time, meaning that the least expensive units are in the ending inventory. And this example here will bear that out. As we see, the cost of goods available for sale is the same as before, $12,000 based on the beginning inventory plus the purchases. And in step 1, in evaluating the ending inventory, we're looking at the 450 oldest units. Those are the ones that remain. The newer ones were sold according to the LIFO method. So we're looking at January 1st purchase, an April 15th purchase, and part of an August 24th purchase, which total up to only $5,000. Remember, the ending inventory under FIFO was, I believe, $5,800, so that's a pretty big difference. And on the other hand, the cost of goods sold, then, when you subtract the $5,000 ending inventory from the $12,000 cost of goods available, is $7,000, which is considerably higher than under FIFO, which I believe was $6,200. So again, when you subtract that higher cost of goods sold from the revenues, you're going to get ultimately a lower net income figure, which is what management that wants to, for example, keep income taxes down by recording less net income would find that attractive. Slide 26. So what we're seeing here excuse me, is the pictorial version again of what the previous slide showed using this time LIFO. And note again that the oldest units comprise the ending inventory, which makes the ending inventory smaller because the oldest units in an economy of rising prices are the cheaper ones. And the cost of goods sold is larger because the newer units, the higher costing ones, were the ones that were deemed as sold, meaning that the net income will be less under LIFO than FIFO, assuming that unit costs are rising, which, given the largely inflationary times that we've been living in, is probably a fair assumption to use. Now moving to slide 27 and the average cost method. And as stated on this slide, the average cost method actually employs a weighted average unit cost that is based on the formula cost of goods available divided by the total units available, as shown on page 290. Then that weighted average cost per unit is applied to all units on hand at the end of the period to determine the cost of the ending inventory. This in turn will determine the cost of goods sold. So now when we look at this busy slide on the weighted average cost, on the average cost method, in this example, note how we start by computing the weighted average cost per unit based on the cost of goods available and the units available. Then that cost is applied to the ending inventory units, that is 450 units times the $12. Then cost of goods sold is simply cost of goods available minus ending inventory, as always. So in this case, after we computed the $12 weighted average cost per unit based on cost of goods available for sale of $12,000, like it's always been, and the available units, which were 1,000, as always was the case, But now we're costing them all at this weighted average cost of $12 a unit, which means that our ending inventory of 450 units times 12 gives us an ending inventory of 5,400, and notice how that is basically directly between what we saw with FIFO of around 5,800, I believe, and LIFO, which was 5,000. Cost of goods sold at 6,600 is again in between the FIFO amount of 6,200 and the LIFO amount of 7,000. So I guess you could argue that the average cost method gives us a little bit of the best of both worlds when it comes to inventory costing. And here again is the pictorial of what went on in the previous slide regarding the calculation of weighted average cost per unit, and then the costing of the ending inventory and cost of goods sold using the average cost method. On slide 30 now, let's look at the comparative results, seeing it all on one page now with FIFO, average cost, and LIFO, and we see that the cost of goods sold is obviously different in each case, and FIFO is the lowest, LIFO is the highest. So the gross profit's also different, and that of course makes the net income different. Note also that under LIFO, net income is the lowest because the ending inventory is computed at a higher cost than the other two methods. Average cost will normally fall between FIFO and LIFO since it's based on an average. Moving to slide 31, this slide expands on the previous one by highlighting the effects of each method on cost of goods sold, income tax expense, and net income based on how ending inventory was computed, and therefore cost of goods sold, and noting that in periods of rising prices, FIFO will produce the effect of lowest cost of goods sold and the highest net income and ending inventory balances. On slide 32, alternatively, in periods of rising prices, LIFO yields the highest cost of goods sold and therefore the lowest net income and ending inventory balance of the cost flow methods. And here's a review question, and hopefully from the previous discussion here on slide 33 you understand why A is the correct answer. Since FIFO means first in, first out, it most closely parallels most businesses that wish to sell their older units in terms of when they were purchased first. And here's another one on slide 34, and in this case, in a period of inflation, the cost flow method that results in the lowest income taxes would be FIFO because it would also result in the lowest income, as we've discussed. Moving to slide 35, another vignette here on ExxonMobil. So see the explanation on page 330, although much of that is really covered above. For LIFO, a better match of costs and revenues, which in turn provides protection against inflation. Those are the things that are for LIFO. Against LIFO, it understates net income and ending inventory, according to its critics, and thus taxes are lower than perhaps what they should be. One interesting note on the IFRS, the International Financial Reporting Standards, which we're not going to talk about a lot, as I've promised. And there is one slide at the end that says that IFRS does not allow the use of LIFO, so comparison with foreign companies in the same industry is difficult. However, as we'll also discuss, companies that use LIFO have to do a comparative with what it would have been at the ending inventory, that is, under FIFO. And we'll see that later on too. Moving to slide 36, although a method once selected should be used consistently, that is a cost flow method for inventories, it is acceptable to change the method in a new period as long as it's fully disclosed, as you see in the example here with Quaker Oats. The company should then prepare financial statements showing the impact of the change so that meaningful comparisons can still be made with prior years. Now on slide 37, we move to the lower of cost or market. And what this is that as market conditions change, the market value of our inventory may actually decrease. There may not be as big of a demand for the product. You see this with technological stuff all the time, electronics and versions that keep improving and making the old ones obsolete. So lower of cost or market could come into play in a period of declining costs or other reasons for the market value of a product to decrease to less than its original cost. Since the market value is the current replacement cost, this makes sense from the standpoint of the conservatism principle, which states that when alternatives for costing are available, the one with the least likelihood of overstating either assets or income is the one that should be selected. So note that the lower cost of market, as we're going to slide 38 here, is used in addition to the cost flow method selected. So it would apply regardless of whether FIFO, LIFO, or average cost was the method used. In the above example, and that is shown also on page 296, the lower figures are shown in the lower cost of market column for each item, resulting in a total inventory cost of $159,000. So you can see that in the text. Going to slide 39 on inventory management, and as described on page 296 again of the text, inventory management is obviously critical to effective operations and can cut both ways in merchandising or manufacturing concern. So we will look at a few ways to analyze how inventory is managed, starting with the inventory turnover ratio. So on slide 40, the inventory turnover ratio provides some insight as to how quickly or slowly inventory is moving through. That is sales based on cost of goods sold divided by the average inventory balance for the period. So what it's telling us is how many times the inventory turned over, that is, how many times the average balance was sold during the period. Then the turnover ratio can be divided into the number of days in the year to determine how many days on average that the inventory is held. These are good measures to indicate whether the company may be carrying too much or too little inventory. High inventory turnover ratio may mean too little inventory is being carried, for example, and you risk running out and losing some sales as a result. On slide 41, this data that's available for Walmart and Target, and this chart's also shown on page 297 of the text, and it can be seen that Walmart's inventory management based on its inventory turnover ratio and days in inventory is better than both Target and the industry average for 2009. As the text points out, the higher turnover ratio means that Walmart is turning its inventory over more frequently than the industry, and that in turn means that the goods are not spending as much time on the shelf before being sold, as the number of days in inventory measure confirms. And with that, we'll close out this part of the presentation.